Welcome to Nasdaq Trade Talks. I'm Jill Maladrino, global markets reporter at Nasdaq. Joining me is Denise Shull, CEO of the ReThink Group. Denise is a renowned performance and decision coach for Wall Street, former securities trader, and expert in neuropsychoanalysis, the fusion of neuroscience and modern psychoanalysis. She's here to discuss the psychology that will lead to what she believes is Bitcoin's continued ascent. Denise, a very hot topic for us. It's great to see you again. Welcome back to Trade Talks.
Thanks so much. Happy to be here.
And Denise, you believe Bitcoin's rise is attributed to three key psychological factors. Let's start with belief.
Yeah. So literally, the human brain perceives what it believes. So that's confirmation bias, meaning if people believe it's got value, it's got value. It literally, I hate to oversimplify it, but if I wanted to give you a rock and you thought that rock had some value, you would maybe give me something in exchange for it. The medium of exchange is based on, do people believe it has value? So, 10, 12 years ago, some people started believing Bitcoin had value, but not a lot of people, and people thought they were crazy. But basically, with each passing year and each passing price level, more people are this has got value. So it's self-fulfilling prophecy, really.
And what's interesting is it leads to the second point, which is FOMO. So explain to us what that is and how it plays into Bitcoin's rise.
Yeah, so fear of missing out is obviously a thing that people know. What people don't realize is we're always predicting an emotion. Actually, that's what goes on behind the scenes in your brain. So fear of missing out isn't just missing out. It's fear of feeling stupid because you missed out, or fear of being embarrassed because you missed out. And those are really motivating factors for any human being, whether it's the institutional guy or whether it's the retail guy, or now the financial advisors. I saw something yesterday that financial advisors are now starting to always be asked about Bitcoin. And they have to come up with an answer, and they have to be worried their clients aren't getting an answer. So it's not just the missing out, though, that's I'll look stupid in the future, and that just makes people do stuff.
Right. Well, and so then we have belief, we have FOMO, and then of course the last piece is necessity, because now all the institutions are getting in it.
Yeah. I mean, the fact that the insurance company Mass Mutual put $100 million into it. Now, granted, to Mass Mutual, $100 million is sort of pocket change, but it doesn't matter. Here you have insurance companies are really staid conservative institutions, right? And they invest carefully and they put anything in it. It matters. I mean, maybe we think, kooky Elon Musk putting money into it. Okay, well, but the thing about Elon Musk putting into it, and we'll see, but he said that they would soon take payment in Bitcoin. Well, I mean, if you can buy a real car, if you see the electrical vehicle as a real car with Bitcoin, okay, we're back to the rock thing, right? If they're it's got value, it's got belief. And I think, I have clients, I have one client who manages $12 billion. He thinks it's going to 400 grand. He can't personally invest in it because the fund can't invest in it. So he's frustrated by that.
That's why they need to get these products out there, such as ETFs or other kinds of wrappers, so that people can get into crypto if they can't actually go and buy the physical asset. But let's go back to your experience and examples as a trader, as a coach, about how these factors impact markets, traders, and decision makers, and what investors on the fence need to do to make that choice whether to get in or out. Because whether it's cryptocurrency or a .com stock from the 90s or a Dow 30 stock, these factors come into play regardless, right?
Yeah. So what people really don't realize that this fundamental mechanism, sun rises in the east of the human brain, is predicting a future feeling. So if you start to analyze that, you're actually able to make better decisions for yourself. So in 2014, when my crazy friend told me I had to get into Bitcoin, I was well, okay, that person's kind of crazy. So I wasn't predicting any future safety from it. Now I personally have a momentum trading background back from my Schoenfeld days. And so, over like 17, 18, 19, I said, you know what? If it goes over 20, it will have proved 20,000. It will have proven itself to me in a momentum sort of way. So when it started going over 20, we started buying it personally. Now that's a way that I look at the market, right? And different people have different ways that look at I was trained as a momentum trader. Other people are trained as a fundamental analyst, or a technical analyst. But with Bitcoin, there's this sort of rolling increase in adoption, but increase in understanding. So it's been so foreign to people, like pets.com was foreign in 1998, which you may be too young to remember, but I remember it. As people gain an understanding and therefore are predicting more future safety for themselves, they're more able to invest in it. So the more press it gets, the more big investors, the more they do feel this fear of missing out, which is really sort of a prediction of not safety. I might be embarrassed or look stupid, or even just be mad at myself because I thought about investing in it and didn't. These factors.
I guess, Denise, what the question is, when you grow up in trading, whether it's something that it's self-taught or you go onto a desk and you understand the principles of risk management, it doesn't let risk come into that as well. Like if you don't understand the product, does it necessarily make sense to trade or to invest it? I mean, don't some of those classical things that we were taught on the desk, and by the way, I started in 1998, so I kind of jumped headfirst in with the .com boom and bust. But doesn't that come into play as well? Does risk mean more than FOMO?
Risk definitely means more than FOMO. It makes me think of asset allocation. And actually, Harry Markowitz, who wrote the Nobel Prize winning paper called Portfolio Selection, who basically came up with the idea of, have X amount in stocks and X amount in bonds. He said, step one is knowing what you believe. This is Markowitz talking. I don't know how to talk to you about what you believe. You got to go off and figure out what you believe. Once you figure out what you believe, then you can allocate your assets accordingly. And allocating your assets accordingly is right. Like, how much could I put in Bitcoin and not risk too much if everyone's wrong? But what are we back to? We're back to belief. And people don't, I talk to like CFA audiences that don't know that Markowitz said that. And that's true. What's a financial advisor do? They try to help anyone understand their situation and probably modify their beliefs about what's a risk, too much risk, too little risk. My clients have these sophisticated risk management systems. Do they always follow them? No. But someone should know like what they're in it and why they're in it, which is really what do they believe about it and what would tell them they're wrong. Like that's the best risk. What would tell you you're wrong about this? And your risk then is like this future lack of safety. If they do it that way, more than just the mathematical way, they'll be able to manage their own decision-making more effectively.
All right, Denise, appreciate the insight. As always, great to have you with us back on Trade Talks. And thanks for joining me. I'm Jill Maladrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.